Ladies and gentlemen, good evening and welcome to the earnings call of Equitas Small Finance Bank Limited's financial performance for Q4 FY24. We have with us today Mr. P. N. Vasudevan, MD and CEO, Mr. Sridharan N., CFO, Mr. Murali Vaidyanathan, Senior President and Country Head, Branch Banking, Liabilities, Product and Wealth, Mr. Rohit Phadke, Senior President and Head Assets, Mr. Natarajan M., President and Head Treasury, Mr. Dheeraj Mohan, Head Strategy and IR. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. P. N. Vasudevan. Thank you, and over to you, sir.
Thank you. Good evening, and thank you for joining the call on what's a very busy week of results. The year has been a good year for us. We have been able to continue our investments in technology, products, and people to help us grow sustainably and create a robust banking platform. The bank has been able to navigate well during the rising interest rate cycle and kept our margins, yields, and profitability reasonably protected. With about 85% of our loan book being fixed rate loans, we had a high impact on our NIMs over the last few quarters. As you may have noticed, on the loan side, we took a call to defocus from lending to NBFCs as well as slow down on low margin products like new commercial vehicle loans. On deposits, we had increased our focus on retail TD, given the customer's propensity to move money to TD to lock in at higher rates of interest. We have also been able to pass on some of the interest rate increase to borrowers in the form of improved lending rates to ensure our margins are reasonably healthy. Parallelly, we also worked on improving the CD ratio, improving it from 103% as of March 23 to bring it down to around 87% by March 24. We had written to RBI and received a clarification that in case of co-borrowers, say an account with borrower A and co-borrower B going into an NPA, then an account with B as borrower and C as co-borrower, and if we have an account with C as borrower and D as co-borrower, and an account with D as borrower, etc., all of them will need to be marked as NPA, even if individually these accounts are standard. We also received an advice from RBI that in case of ESOPs given to staff who are not covered under the guideline of material risk takers also, against the current practice of accounting for them by way of intrinsic value, we should account for them under the basis of fair value method using Black-Scholes model. After accounting for all of this, we were still able to deliver a decent bottom line for the quarter. Technology has been a key focus area for the bank all the while. While the LOS was rolled out for vehicle finance last year, during the fourth quarter, we were able to roll out the LOS for small business loans and home loans. Implementation of state-of-art CRM is underway. A revamped mobile and internet banking platform is also soon to be launched. We have also upgraded our core banking and other technology infrastructure. We have also introduced a few innovations like Banker on Wheel, which is being piloted currently. We are confident all of these investments will help the bank in its quest to give a differentiated experience to customers. While we have been using digital effectively to enhance customer acquisition, we are also focusing on how to harness technology to bring about enhanced controls over critical processes in the bank. We have committed to a certain level of resources to give focus to these action plans. These initiatives would further add to the bank's ability to sustainably grow. In this quarter's presentation, we also try to provide some direction on what the bank's long-term strategies around technology and liabilities are. We are strongly committed to put in place key enablers to help us become more competitive in the next 3 to 5 years. Our strategy continues to be to build a well-diversified new age bank, delivering consistent returns over a long period of time and showing resilience across market cycles. We also stay committed to giving back to society through our two trusts, Equitas Development Initiatives Trust and Equitas Healthcare Foundation. While the Equitas Gurukul schools continue to do well and help produce good quality students from economically weaker sections, our cancer hospital has started operations effective November 23, and that has been progressing well. We have completed over 165 surgeries in the last 3-4 months. We also treated more than 4,000 people in this few months. So with that, I hand it over to Rohit to talk about assets.
Good evening, everybody. Advances have grown by 23% year on year. SBL advances have grown by 30%, microfinance by 20%, vehicle finance by 19%, and affordable home loans by 60%. Ex-bucket collection efficiencies have been stable at 99.5% in SBL and microfinance, and 99.7% in home loans, and 99.1% in vehicle finance. In SBL, small business loans, the merchant OD product has scaled up very well with 39,000 plus customers and advances of 950 crores. We intend to keep growing these volumes. Other than merchant OD, the focus in the coming year will be growing the micro lab book. Microfinance has gone fully digital with 100% adoption of eKYC and eSign. We continue to maintain that the unsecured book will not exceed 20% of advances. In vehicle finance, used car advances have grown by 71% year on year with advances at 1,224 crores. The focus in the coming year will be on the growth of the used car and the used CV book. We will defocus on NCV, but we will continue to run the product. Affordable home loan portfolio has scaled up well with advances growth of 60% year on year at 2,500 crores and a GNP of 0.5%. On digital initiatives, Newgen LOSs has gone live for both small business loans and affordable housing. We have also launched a customer app called as Selfie Loans, which will serve as a one-point contact for our existing and new customers. We have been able to increase disbursement yields by more than 1% from 17.43% in March 23 to 18.74% in March 24. Demand at the field level continues to be strong, and I am hopeful of a good year ahead. Thank you. I am handing it over to Murali.
Good evening, friends. Let me take you through a few of the snapshots other than the figures which is available there for your perusal. I think this has been a very testing year, not only for us, but across the industry. I think overall, in terms of retail focus, which we have been talking about till this point of time, building a scalable and sustainable franchise so that we can leverage, over a period of time. So we are deriving two phases to it. What has happened and what is going to happen, we'll cover it in, two chapters. First thing is, through the year, few significant milestones which we want to say is this year, while TD growth has been phenomenal, we have, got into the 444 days as a unique proposition. The good part is number of new to bank customers entering the stream. We could add close to 1.2, 1.3 lakhs of new to bank customers who have come in through this as an option and then migrating into savings account is one distinctive edge which we could get into these customers. Second part is our NR book has crossed 2,000 crore and we are now present in 110 countries. That's customers across. So that's a significant thing with AD1 project being on the anvil. I think this is going to grow further, and our time zone based VRM is actually helping us to deepen further and further. Third important thing is our relationship management structure. What we have put in at this point of time is yielding good dividends, because despite being a tough year, you could see as we end the Q4, our growth on SA, our growth on CA, our growth on RTD, and importantly, retail mix of what we are maintaining 72 and 28 on bulk, we could hold that. And so this is helping us to go deeper and deeper into these families. And fourth important thing is, most important thing which I want to say is our digital book has crossed 1,500 crores, which we have acquired through digital and full KYC accounts. So this four is on the liability side. On the PPP side and the fee-based revenue, thanks to the InsurTech, where we, like Vasu sir was saying, that we are using technology not for only disruption. Sometimes technology as a facilitator, InsurTech is going to be one sort of a thing which has helped us to garner general insurance and health insurance totally through the same platform. Now life is also integrated. As we move along, I think this will be the biggest productivity enhancer. Adding to the TPP, we have a range of AUM growth in form of mutual fund. Predominantly, we focus on SIP. We have added close to 18,000 active SIPs in last 1 year who are now doing, continuous investment through us. Third important proposition which has helped us to build size, as by what we discussed in the last call, we have now close to 20,000 customers whom we have mentioned in the presentation also, who are, ability to use and block, and then, then it's their allotment. But the good part is now from a saver to investor to, we are getting into the trader segment also. So all these 3 segments, we have a proposition, and all can be done digitally is one unique proposition that had happened. And last but not the least, as we keep expanding, now we are philosophically moving towards a situation what we have mentioned in the presentation, that is moving from unitary sourcing to family sourcing as one key vertical, which means going deeper at a family level, having a family level proposition one. Second is focusing on mass only for SAL as a segment through digital sourcing. And third, getting AD1 and NR as a proposition is going to be, these 3 is going to be one of the key forefront drivers as we get into coming years, because only through that we believe that our cost of funds can be managed. And fourth and last thing is transaction banking and current account, which we will touch. So overall, it's been a very encouraging year. Overall, I think the patronage of customers as well as, employee productivity has been good. And I wish, we will sustain this momentum in coming days. Thank you. I'll hand it over to Nat.
Good evening, friends. Q4 of FY24 has been a relatively good quarter in the market front. On a quarter-on-quarter basis, Indian 10-year yields trended lower and closed just above the 7% mark, as US rate cut expectations and anticipation of inclusion of Indian bonds in global Morgan Stanley bond index triggered a risk-on rally in India bonds. However, the US Fed continues to be data-driven, but ongoing geopolitics has slightly tempered expectations of earlier and faster than expected rate cuts, and the market is divided on the horizon of the US Fed's attempt to bring inflation below the targeted level of 2%. It is a good quarter for equities globally. Dow Jones gained almost 6%. Indian equities also continue to see a run-up, but more modest in Q4 FY24, with gains of almost 2.8 for the frontline Nifty 50 index, which continued to rise about 20,000 levels. For the upcoming quarter, short-term volatility is not ruled out as we approach national elections. Street has priced in a likely outcome of elections, and barring any negative surprises, we expect both equity and bond markets to stabilize towards the second half of the quarter. Supply lines can be an issue, especially for oil, if situation in Israel and Gaza worsens and result in higher inflation. Escalation by Iran continues to stoke fires. As such, geopolitics could be a slightly more pressing issue as we move ahead. Despite India's economy continuing to stabilize, consolidate and grow, considering the global nature of trade and supply chain, we can expect volatility going ahead despite a strong local economy. Hence, we view the market as cautiously optimistic. We continue to remain positive on the India growth story over the medium term to long term, as domestic economic activity continues to be resilient and is expected to further pick up in the new financial year, as government's infra-led spending along with private capex are expected to accelerate. We will await the budget post-elections for further clarity on focus areas for the new government. Thank you, and I hand it over to Sridhar.
Good evening to everyone. Our net interest income for the quarter came at 786 crores as compared to 707 crores during the same quarter last year, registering a growth of 11% Y-on-Y. Other income for the quarter came in at 222 crores as compared to 215 crores during the same quarter last year, registering a growth of 3%, resulting in a net income growth of 9% year-on-year. The total operating expenditure came at 634 crores and remained stable with an increase of 4% sequentially. Pre-provisioning operating profit (PPOP) grew 4% Q-on-Q to 375 crores and PPOP to assets remained stable at 3.45% for the quarter. PAT for the quarter came at 208 crores as against 190 crores during the same period last year, registering a growth of 9% Y-on-Y. ROA and ROE for Q4 FY24 stands at 1.91% and 14.22% respectively. Next is on the one-time P&L impact items in Q4 FY24. The first based on the bank's proactive clarification obtained from RBI pertaining to classification of loans of co-borrowers, when the primary borrower's loan account becomes an NPA, the bank also classifies the co-borrower's loans as an NPA. The bank has classified 38.45 crores worth of loans as NPAs during the quarter, and 15.17 crores has been provided as a provision on account of this classification. Second one, due to change in accounting policy as per the RBI advisory, the bank has expensed 29.21 crores additionally as an ESOP cost in respect of the grants issued after 1st April 2021 in respect of non-material risk takers and control staff. Third one is a benefit which is of 11.89 crores on account of the excess provision for gratuity and leave encashment as per the actual valuation. We estimate that our PAT, ROA and ROE adjusting for these would have come in at 233 crores, 2.15% and 15.93% respectively for the quarter. On the one-time impact, cumulatively for the year we have taken a hit of approximately 75 crores towards additional provisions and employee costs on account of ESOP. The recurring costs on these items will be marginal. During Q4 FY24, the bank has securitized and assigned advances worth of 584 crores pertaining to HF and DF advances. The total provision for Q4 FY24 is at 107 crores, which also includes a provision of 15.17 crores pertaining to provisions under the co-borrower accounts, which has been explained, even though they were standard on a DPD basis. GNPA improved by 8 bps Y-on-Y to 2.52% in Q4 FY24 as compared to 2.6% in Q4 FY23. Including the securitization book, GNPA would stand at 2.39% and NNPA improved by 2 bps Y-on-Y to 1.12% in Q4 FY24 as compared to 1.14% in Q4 FY23. Based on the current advances mix, the bank is maintaining a healthy PCR of 56.06% and it continues to follow stringent provisioning norms across all asset segments. On a full year basis, the bank has registered a balance sheet growth of 30%, PAT growth of 39%, ROA of 2% and ROE of 14.43%. Our net worth now stands at 5,969 crores with a book value at 19.01 per share and earnings per share of rupees 7.12. As of March 31, 2024, the total TRAR at 21.7%, with the Tier 1 at 20.71 and Tier 2 at 0.99%. The Board of Directors have proposed a dividend of 1 per share, subject to the approval of AGM. With this, I would like to hand over to operator and will be happy to take over the questions from your end. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Shripal Doshi from Equitas. Please go ahead.
Hi sir, good evening and thank you for giving me the opportunity. So the first question was pertaining to the RBI clarification impact on the P&L. So, like which segment of loan book was this coming from? And just wanted an update on the Tamil Nadu flood related impact on each of the segment for us.
Hi, Sripal. Rohit here. Most of the co-borrower impact is coming from the SBL portfolio. And Tamil Nadu floods impact is now more or less gone away. It's very minor stuff which is remaining, which will get evened. As of now, there's no future this thing. It will get evened out.
Okay. And so on the MFI front, like in the deck, it is mentioned that it is doing well and we are seeing improved loyalty from the customers as well. But if you look at the GNPAs for that segment has been inching up in the last 2-3 quarters. So what explains that? Are we like, if you can throw some light on that?
Sure, Sripal. So in microfinance, if you look at the industry, everybody has written off a large amount of, a book, some amount of book every year. We have not written off a single rupee this year. Secondly, if you look at the data which is released by MFI Association, they have given data on the PAR 90 to 180. On the PAR 90 to 180, the industry is at 1%. Small finance banks are at 1.1% and Equitas is at 0.9%. Third, post-COVID, we realized that some of these customers do come back when you go to collect. And we have beefed up our collection to ensure that, we go and collect that money. Otherwise, earlier the trend was the moment, 90 plus happens, the industry would simply try to write it off. But I think post-COVID, we've seen that, and that is why we beefed our collection. I think the microfinance GNPAs will be range-bound between 3.5% to 4.5%. Does it answer your question?
Yes. So that will be the new normal for us.
Yes.
Or for the industry also, you feel that it will be an elevated number?
Yes, for industry also, it will be an elevated number is what I feel.
Got it. So one last question was on the cost of fund side. So, do you feel like are we nearing to picking out on the cost of fund? And just how do you see the trajectory on the NIM side because of the cost of fund implication?
See, with regard to cost of funds, I think more or less interest rates have peaked, and as we keep on repricing, another 10 to 12 bits is what is seen as on the higher side. So which means present position plus 12 bits is what seen for this quarter or for this half year. Now, this will be because of two reasons. Now, it is directly related to what is going to be the rate cuts post the second quarter. So till that point of time, our maturities, which were supposed to be repriced at a higher level, almost 80% to 82% is already through, and incremental deposits are almost frozen as a rate for last 2.5 quarters. So I think another 10 to 12 bits is what we are seeing it as a cost of fund. There is on NIM.
On impacts on NIM, so just to recap, FY24, the impacts on NIM were largely because of one, interest rates going up, second, enhanced liquidity in the balance sheet because of improvement in CD ratio. Today, where we are, we don't think these two are driving forces for FY25. So NIM should largely be where it is and only have an impact of the portfolio mix changing over a period of time. So you should expect NIMs where it is right now.
Got it. And I mean, there's no likelihood of portfolio mix changing because I think what we had guided or what we had said is that we've broadly achieved our targeted mix. So is there a thought process to tweak that mix as well?
Yeah, so we have what we also said is in the medium term and in the long term, our secured to unsecured ratio will remain 80 to 20, while microfinance as a portfolio will continue to reduce in terms of portfolio mix. So to that extent, there will be some impact on the NIMs.
Got it, sir. Thank you so much, sir, for answering all my questions, and good luck for the next quarter.
Thank you. In order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participant. If you have a follow-up question, you can rejoin the queue. The next question is from the line of Sudarshan Nachimuthu from Prosperity Wealth Management. Please go ahead.
Hope you can hear me. So my question is on your CD ratio. So you have guided to close the year with 90% CD ratio. However, we are close with 87% as of this quarter. So, what was the reason for bringing down CD 300 more bits more than the guided range?
To 85. What was the reason?
Yeah. So we had been working towards bringing the CD ratio down over the last year, and again, the plan of 90, it has come down to about 87. Yeah. So this year, our plan is to bring it down further to about 85 by March 25. So this 2% is something that we'll be working on over the rest of the year.
Okay, sir. And you mentioned you have securitized vehicle finance and housing finance portfolio came to find it here this quarter. However, the yield drop of around 40 basis is mainly from this final year securitization?
Yes.
Given the low quantum of securitization and 50 basis point drop in yield, can you explain a bit more further on it?
Yeah. So, yields at the portfolio level have dropped largely due to securitization. So about 1,700 crores of loans, and that's about 1,100 odd of vehicle finance, and the rest is housing finance. So that interest income is roughly about 60 to 70 crores for the quarter. So that's what has led to the portfolio yield drop.
Okay.
We accounted as EIS in the other income. In the presentation, you will see it under other income and asset fees.
Okay, sir. Okay. And your incremental disbursements during this quarter, those yields have also dropped. So, couldn't we focus more on high-yielding products, and what was the reason for it?
Yeah, so like we said, we are slowing down on loans to NBFCs and new commercial loans, new commercial vehicle loans, which are typically lower yield loans. So that is one direction which we have taken. We've done it the last couple of quarters, and also going forward, we've given that as a guidance. So that should ensure that yields also at a portfolio level stay at these levels.
Okay, so your Q4 yields would be the stable yields?
That is too fine to actually look at this Q4 as stable yield. But I think you should look at it from portfolio mix and from the guidance we've told you how products will be slowing down and what we're accelerating. So don't hold us to Q4 as a number for the full year. But I think rather try to focus on NIMs, and we try to keep NIMs stable for the year.
Okay, I understand on that part. Coming to the next part, so what is your current outstanding write-off pool as of this financial year closing?
Outstanding write-off pool. Sorry, can you just repeat the question? Outstanding?
What is the write-off pool remaining with your bank? So during 2-3 years, you've written off certain amount of loans. What is the existing?
No, we have not written off anything this year.
Okay. Okay,
Yeah.
sir. And just a follow-up question on your co-borrowing classification. So you mentioned it is for small business loans. So is it also going to affect the microfinance loans given the...
No. Just to correct you, see, this is at a customer level at the bank. So it is not specific to one product you do it. NPA is at the customer level at the bank. Where the NPA of 38 crores has come from is what we said is largely from small business loans. Like, microfinance doesn't have co-applicants. Co-applicants are largely in the other books. But this norm is applicable at the bank level for all products because it is at a customer level, not at the loan level.
Okay. Thank you. That's it from my end.
Okay, thank you.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Congratulations on good performance, and thank you for giving me this opportunity. So, first question is, what will be the share of 440-day and 880-day deposit products in the stock and in incremental TD sourcing?
In incremental TD process today, it is close to 60 to 65% of the incremental sourcing.
Yeah, both the products.
Yeah.
Okay. Just one clarification, when you report yield on gross advances and yield on advances, this yield on gross advances